Hello friends, this side CA Pankaj Bansal. Here we are to discuss some important topics of the chapter of accountancy called as dissolution of partnership firm. For that, we first of all need to understand the meaning of dissolution. What is this dissolution stands for? Dissolution stands for closure. Dissolution stands for closure. Now, let us understand the meaning in detail. There are two types of dissolution. First is dissolution of just partnership. There is just a dissolution, that is closure of partnership. And second type of dissolution is dissolution of partnership firm. What is the difference between these two terms? We need to understand the difference between these two terms in very detail. It is very important. Let us understand. We already learned these four topics. That is card. What is card? Card is change in PSR. A is admission of a partner. R is retirement of a partner. D stands for death of a partner. We already understand the chapters in detail in our 12th class or CA foundation class. What is the basic root in all these four chapters? There is an old partnership agreement. There is old partnership agreement which comes into end, and a new agreement comes in existence. So my little friends, my dear friends, when the old agreement among the partners comes to an end and new agreements comes into existence, this is called as reconstitution of partnership. That is, there is a reconstitution in the partnership agreement, and this reconstitution of partnership agreement is termed as dissolution of partnership. Now, but what is difference in dissolution of partnership firm? It is nothing, just closure of business. This is closure of the business when the business is locked down. When the business is locked down, that is, we need to close down our business. This is called as dissolution of partnership firm. So in both the situations, there is a closure. There is a closure of old partnership agreement, then it is termed as dissolution of partnership. But when there is a closure of the business, this is called as dissolution of partnership firm. What else? As there is assets and liabilities in our balance sheet, but these assets and liabilities are revalued in case of admission, retirement, death, or change in PSR. But we need to realize the assets and liabilities and to settle the liabilities. That is, realize the assets and to settle the liabilities. So we need to prepare an account called as revaluation account in case of dissolution of partnership, and realization account in case of dissolution of partnership firm. What else? The relationship among the partners. Instead, we can say that economic relationships among the partners comes to an end. Relationship among the partners comes to an end in case of dissolution of partnership firm, but here the relationships shall become continue. Relationship among the partners will continue as it is, which was before. Just there's an agreement changing, but the relationship is still intact. So this is the main basic conceptual understanding of this dissolution. Now we need to understand what are the modes of dissolution, why the dissolution takes place. Let us understand. Now, next topic is modes of dissolution. We all know that partnership comes into existence with an agreement. So partnership can come into end with an agreement. That is partnership agreement. If all the partners decides to close the firm, then they can do so by putting an agreement which is called as partnership agreement. With the help of partnership agreement or partnership instrument, the firm can be dissolved. The second case is compulsory dissolution. A firm needs to be compulsory dissolved. The firm needs to be compulsory dissolved in two situations. When the business of the firm is unlawful or illegal. When the business is illegal, then the business needs to be closed down. Then it is a case of compulsory dissolution. Or what is the second case? When all the partners are insolvent, when firm became insolvent, when all the partners are insolvent, then the firm needs to be compulsory dissolved. Plus, there is one more case which already covered in second case. All partners except one. If there are 4 partners in the firm, out of that 4 partners, if 3 partners are dissolved, if 3 partners are insolvent, even in that case, the firm needs to be dissolved. All partners except one are insolvent. In both the situations, when all the partners are insolvent or except one is insolvent, in both the cases, the firm needs to be compulsory dissolved. Then third mode is by notice. A partner can give a notice in writing to dissolve the firm. That is, firm can be dissolved by a notice given by a partner in writing to dissolve the firm. Next, fourth, the firm can be dissolved on happening of an event. What is that event? Let's suppose we started our partnership on basis of some term. For example, A and B decided to carry on the partnership for just 2 years. On the completion of that 2 years, the partnership needs to be dissolved. That is on expiry of a term. When the term is being finished, the firm needs to be dissolved. Second, on expiry of a venture, on completion of a venture. Let's suppose they have decided to form the partnership to complete that particular business, that particular venture. When that business is being completed, then the firm needs to be dissolved on completion of a venture. Then third point, we write it here, on death of a partner. Yes, my dear students, on the death of a partner, the firm needs to be dissolved. And fourth, on insolvency of a partner. That is, on death and insolvency of the partner, the firm needs to be dissolved. But there is some ifs and buts in these cases. However, in both these cases, although the firm will be dissolved, however, there are some exemptions given by the Partnership Act 1932. However, the remaining partners can continue the firm. If the remaining partners decided to continue the firm, then the firm can be continued in this case also. But this exception is only for third and fourth category, that is death or insolvency. And last final case, the firm will be dissolved on order of a court. That is, court may intervene. In the intervention of the court, the firm needs to be dissolved. There are 7 cases. There are 7 specific cases in which the firm needs to be dissolved. What are these 7 cases? In first 4 cases, if the partner is found to be PUBG. What is PUBG? PUBG is permanently incapable. Permanently incapable to perform his duties. When the partner is found to be incapable to perform his duties, then the firm needs to be dissolved by the intervention of the court. Then second is, person is found to be unsound mind. When a partner finds to be of unsound mind, then the firm needs to be dissolved. B stands for breaching. What is breaching? Breaching persistently. Breaching persistently the partnership agreement. If a partner is disobeys, breaching the partnership act, the partnership agreement which they are already made, then the firm needs to be dissolved by the intervention of the court. And fourth is guilty of misconduct. If the partner is found to be guilty on some misconduct done by him, then the court intervenes and the firm will be dissolved. We have discussed that there are 7 cases. First 4 cases is of the partner, that is permanently incapable to perform the duties and person of unsound mind, breaching persistently the partnership agreement, guilty of misconduct. Then 5th, 6th and 7th is CLT. What stands for CLT? C is when court, that is court finds it just and equitable. When the court findings prove that the firm needs to be dissolved on just and equitable grounds, then the firm needs to be dissolved. Then 6th, loss. That is, this business cannot be continued. Business cannot be continued except losses. That is, business will be continued by incurring the losses only. Then court intervenes and the business will be closed. 7th, when a partner transfer his or her interests in business, that is his profit share of a partner, that is it's his interest, and he is transferring that interest to a third party. When a partner transfers his interest to the third party, in this case the firm will be dissolved by the order of the court. That is, these are the 4 PUBG of the partner grounds, and these CLT stands for court, loss and transfer of his interest by the partner. This is also a case of partners, but we have converted it to PUBG and CLT. I hope the 2 important questions are already clear to you. Now, my dear friends, we need to understand the accounting treatment. What is the accounting treatment for closure of the firm? See, in accountancy, the business will be closed when the balance sheet will be closed. There are assets and liabilities in the balance sheet. All we know, assets are having the debit balance and liabilities is having the credit balance. So we need to close this balance sheet, then only our balance sheet will be closed. Now we have to follow some steps to close this balance sheet. Step number 1, that is transfer all assets to realization account. We already understand that what is the realization account. Realization account is prepared to transfer all the assets and liabilities. So in this case, we transfer all the assets to the realization account. That is, realization account will be debited, and all assets having the debit balance needs to be credited to sundry assets account. So realization to sundry assets, you need to write the narration being assets transferred. Now, what is important here, need to mention that all assets are transferred except cash and bank balance. Generally, cash and bank balance is already realized. So there is no need to transfer such cash and bank balance to the sundry assets. Similarly, partners capital account, partners current account, then losses, profit and loss balance, that is, these are the debit balances, which will be transferred to partners capital account in profit sharing ratio, need not to be transferred. Then what is step number 2? Step number 2 is transfer all liabilities to realization account. Then what is the journal entry for transferring the liabilities to realization? See, liabilities are having the credit balance. So we need to debit the liabilities, that is sundry liabilities account debit to realization account. Being liabilities transfer. Now, here is again a special point. Partners capital, partners current account, not to transfer. Yes, sorry items, these all items not to transfer. To what? Realization account. First is partners capital account. Then second is reserves, profits. Then third, what is third point? Partners loans account. Partners loans need not to transfer to the realization account. See, let's suppose any investment fluctuation reserve or depreciation reserve, these are all funds, but against these funds, if there is no asset, that is, if there is investment fluctuation reserve, but against that investment fluctuation reserve there is no investments in the balance sheet asset side, then it is not a reserve, this is a fund. And these are not the funds, this is called as reserves, and these reserves will be transferred to the partners capital and current account, like these are the reserves and profits. So these will be transferred to partners capital account directly and will not to be transferred to the realization account. These are the two steps. Now, what are the third step? Third step is realize the assets. Realize the assets. And fourth step is payment of liabilities. Payment of liabilities. Assets realized in cash. Then cash account debit, what comes in? 2. As already all the assets are transferred to the realization, so we realize the cash through realization account only. Then cash account debit to realization account. If partners take over any asset, then entry will be partners capital account debit to realization account. Similarly, liabilities will be paid in cash. Entry will be realization account debit to cash account. If partner pay offs any liability, the entry will be partner's capital account. We will realize that liability, we will settle that liability with the help of partner's capital account. So entry will be realization to partner's capital account. See a specific case when any asset is handed over to a liability. When the asset is handed over to a liability, see, already asset is transferred to the realization account and the liability is transferred to the realization account. When asset is handed over to the liability, then realization account automatically matches. Then there is no need to pass an entry. Then there is no entry for handing over a liability to a handing over an asset to a liability holder. Similarly, liability is settled by handed over an asset. In similar situation, there will be no entry. Then these are third and fourth steps. Now, fifth step. There are some cases of realization expenses. Firm is closed, then there are cases of realization expenses. When it is paid, then realization account debit to cash account. There are some specific cases which will be discussed in the later classes. Then we will close our realization account. In this situation, if there is profit, then profit is transferred to the partner's capital account. So journal entry will be realization account debit to partner's capital account. But in case of loss, concerned partner's capital account will be debited to realization account. And last step is settling the accounts. After all these above entries, all above 6 steps, after completing all these 6 steps, if any partner needs to be pay off, if firm needs to pay off, if firm is paying off the partner, then partner's capital account debit to cash account. But if partner pays off to the firm, he is enough capable and solvent himself to pay to the firm what is the amount due by him to the firm, then cash account debit to partner's capital account. These are all our 7 steps which we need to take care. Thank you.